here's the truth. If you don't invest the money, inflation is going to eat it away. There is no way, there is no idle place to keep money. No idle place to keep money. If you keep it in a bank, inflation eats it away. In fact, they might even chip away at some, they take away some charges, some of these things. That is even outside of what inflation is going to do to the money. Yes, absolutely. So the money you are investing in the market should not be something that, it's very close around the corner. We had a guy back then when we were in the university. This guy played bets with the school fees. And then we had to graduate before him because he couldn't come up with the money again. So that type of situation. Imagine, where you're ending up in the streets because, you took your rent and then you put it in the market.
If you ask the regular Nigerian today, why are you so skeptical about investing? You hear something like, hey, they've come again, CBEX, and you start hearing a lot of ignorant statements, and really, who can blame them? Because of recent, and even from the past, we've seen a lot of Forex frauds, Ponzi schemes, and even the most recent cryptocurrency crash. People are scared to lose their hard-earned money. And so people do not come to terms, I believe, with the fact that if you fear invested in total, you even you become more susceptible to not getting aware on how to mitigate or navigate future scenarios. And so today on Everyday Money Matters, proudly brought to you by Nairametrics, we are asking that same question. Why are Nigerians pretty much skeptical about investing? And with me is a familiar face on the house. We have Chikwado Hossana. He is a portfolio manager. He's an investor. And of course, he is a trading trainer. He's the founder of Chikwado Trading Academy. And then he'll be taking us on everything we need to know about investing, from the fears to the red flags to the scams. In fact, it's a whole lot. Welcome, Chikwado.
Thank you very much, Shagun. Thanks for having me.
Welcome. You might want to do just a little bit of introduction for 1 minute.
Okay. There's nothing. I've been here. You've basically said everything there is to be said about me. So I'm an investor. I'm a trader. We run a trading academy as well, a Chikwado Trading Academy. So the idea is to provide education and give Nigerians an idea of what real investing is, and not just to, get rich quick or, all the type of nonsense that flies around these days. So what we're bringing is the real stuff in the real world and something that every person can relate to. So that's, ideally what we are about at Chikwado Trading Academy. And of course, myself, I've done this for a while, and it makes sense to actually share that knowledge with the world right now. So
thank you so much. And in that regard, in your own words, what is investing in plain terms? Or what do you regard it as?
Okay, so investing is, getting your money to do the work instead of you doing the work.
Okay.
So there are two types of income. You either have the active income, where you go, you do a job, you get a salary, or you engage your energy.
Actually,
yes. But then the other one, we have passive income. In this instance, the capital is working. The money gets into the markets, in any market or wherever. It just does the work for you. So that is what investing is.
Okay.
Money working without the individual doing the work. So that's what investing is in simple terms.
Okay, because if you ask the average Nigerian to them, when they think of investing, it's just about somebody asking them to just, commit their funds into something that, for an ROI at some point. And so for the Nigerian listening right now, what are even some investments that did I say they're subconsciously into and they probably do not know? Does any come to mind at the moment?
Okay, so ideally, what you just said is very correct in terms of, taking money and putting it into somewhere. But the angle that I'm going to look at it from is that for every single money you are going to put anywhere, there has to be a reasoning behind it. There has to be a rationale behind it, and part of one of the things that people invest the most that they don't even know that they invest is time. They invest their time. For instance, if you're going to work at a job, that's your time as well being invested.
Time is money.
Time is money, so that's the ultimate investment that people make. But at the end of the day, what's the ROI for you when you've invested your time? Are you investing in something that, long-term pays you, consistent dividends, or, you just, take it in the short term? For instance, your salary is extremely short-term. At the end of the month, you get that, and that's it. And there is no sense of ownership, with what you've just put your time into. So the idea of investing is committing the capital to do the job and to also give you ownership. So, for instance, you own a business, you're an owner, you own stocks, you own bonds. The idea of investing is to actually make you an owner. Properties, real estate. An investor, by default, is an owner. So that's really, the prime thing. So if you're investing some way, somehow, and you're not owning, that's actually one thing that you can be doing, and that's it's not giving you the proper ROI that you should be getting for
I
that.
remember the last episode we had on the Novice, you did make a statement that trading gets you rich or investing makes you wealthy.
Yeah, it makes you wealthy.
Or something like that. Still, buttressing your point on ownership.
Yeah.
And then let's address the elephant in the room, which is on the fear. Because this is not me just speaking of we have the numbers here that although retail participation in the NGX has risen sharply, Nairametrics published it that retail investor now accounts for nearly half of domestic trades. And, basically, we see that people do not still trust the systems. And then I'm still skeptical as to how these scheme apps even work, because I know or I understand that there are supposed to be a couple of rules or guidelines before you can just come up and set up an investment platform. I think there's the NDIC, FCCPC, and sometimes even the CBN. So can you just walk us through, how do you think, these scheming platforms, even, how do they work, and how do people even get to just commit their monies into it?
Okay, so what I'm going to say is that there are regulators. The prime regulator for everything investing in Nigeria is the SEC, right? The Securities and Exchange Commission. But you cannot rely on the regulator to do your job for you. As an investor, you're committing capital. Usually regulators don't step in before the event happens. Regulators only step in after the event has happened.
But that shouldn't be the case. I mean, for you to even be registered and say you're an investment company, you should have gone through the necessary documentations. I shouldn't have been having to worry that this is a phishing.
Yeah. So ideally, in the money scene, there are a lot of people. There are a lot of players all over the world. There are a lot of players who are not so legit, right? They appear everywhere. So at the end of the day, the prime duty of the investor, first of all, before you even know what to invest in, your first assignment should be to even understand the platform. On any form of ridiculous ROIs, it's okay. We had the MMM several years ago, and we've had several schemes, like that come and go. The everyday Nigerian is not really doing enough research. And part of why you see some people get into investing is they just see that a system is promising money, and they want to give the money out so that they don't do the work.
That's why it's called passive income. I'm not supposed to be doing the work.
Yes, you're not supposed to be doing the work, but there is a work before you relax. And the work you have to do is to find the right place and the right platform for your money. And if, for instance, the SEC is supposed to be sitting at the helm of affairs, overseeing these investment activities. And a lot of times, I went through the SEC website, some about last week, I was going through the SEC website. I wanted to find the database for every company that is registered on the SEC, and I couldn't find that. That's on the SEC website. Maybe it might be there and I didn't see it well, but I went on the search. I tried to type the name of a certain company that I was trying to, do a research on, and it wasn't there on the SEC website. So at the end of the day, you should do some homework. And now I know how to do that homework because I'm an investor myself. The everyday Nigerian, we need to educate them to a point that even if you don't know how to invest, you don't understand commercial papers, you don't understand stocks, you don't understand treasury bills, you don't understand all these things, at least understand how to appraise a platform.
Okay.
Understand how to, evaluate and say.
So what are the guidelines, or should I say stuff they should look out for?
First of all, the companies should have a face. Just like the way you identified me, and you said, this guy's from Chikwado Trading Academy. The first thing is that the company should have a face. They can't come from nowhere.
Many companies like that, CBEX had a face. They had an office in Ibadan, like a physical office, what we call physical evidence, in marketing. So, I mean, a company having a face, we've seen these phishing companies still that, apparently appear to be real, and have these structures, and you just see it's all a facade. So do you think in today's world, and also in today's world where majority of companies are even going digital, might not necessarily have a physical, or should I say, I'm saying, do you think that is feasible enough, or does that hold enough water? The company just being
okay, so like I was saying, the company should have a face, right?
Okay.
They should have some registration, basic stuff from CAC, and then they should have SEC oversight.
Okay.
Now, if they have SEC oversight, they have some registration, they have some of these things going in their name, you should listen to what are they even investing in. For instance, if a hedge fund is going to approach a customer, approach a client, a potential client, that fund will tell the client what they are invested in and the expected returns, not the ones that is in front, the ones that have happened before in the past, because you don't really know what's going to happen in the market. Just like the crypto crash we saw on Friday. Nobody saw that coming. Even though, I'm going to get to that. I'd spoken to someone about it, that was going to happen. I didn't know it was going to happen that fast, right? So if you're going to approach an investor, they ask a lot of questions. Proper investors ask a lot of questions. How much risk are you taking in the market? What exactly are you investing in? If these guys are not able to answer this, and then there are a lot of things, for instance, they are custodians that should hold the money, there should be auditors. There is a lot that a firm should put in place. And if you don't see those things in place and you are doing business with them, that's basically sitting on a keg of gunpowder. And, the fact that, that's their office, that's not enough.
That's not enough.
No, it's not enough. That's the office. That's the anybody. You can rent an office and, sit there and say anything, but if you don't have a proper team, having government oversight on all of those things, at the end of the day.
You did mention hedge funds, and the way you mentioned about oversight and the likes, it sounds like something for the rich only. So could you get to just speak about a bit on asset management? Is that where asset management comes in? The fact that you will need companies to regulate, like a firm, a credible firm to regulate all of this. Is that where asset management comes in? Speak a bit to asset management and hedge funds.
Okay, so the ideal thing is that the asset management, traditional asset management firms are, open to everybody. If you go to, let's say, for instance, I'm not going to mention anybody's name, but these banks and all this, they have asset management divisions. And then there are some standalone asset management firms. If you go to their offices, they show you a wide range of products that, you can invest in, from their mutual funds to their treasury bills and all of these things. And maybe their money market funds. These asset management firms, they are traditional. And what I mean by traditional, they allow anybody, it's for the public. You can put 5,000, you can put, 10,000, you can put 2,000, 1,000. I don't know why you would be investing 1,000 or 2,000 anyway, but I'm just saying.
as the money comes,
it's for the masses, right? So anybody, you can invest, and go to them. And, with traditional asset management firm, they're not allowed to use leverage in terms of, borrowing and taking heavy loans to invest, heavily in order to amplify returns and all that. They're not allowed to do that. And they are heavily regulated by the SEC.
Okay.
But a hedge fund, on the other hand, doesn't have that type of heavy regulation. But what they do is that they are strictly for high net worth individuals, and you don't advertise it publicly. You don't, put up a banner. I'm sure if you are going around, maybe Lekki here, or you're going around, you can see that some asset management firms advertising, putting up their billboards and telling you to come and invest with them. Those are regulated asset management. And then the SEC has an oversight on what they can invest in. But a hedge fund does not have that type of oversight, and therefore it is not allowed to be marketed to the public. And they use leverage. So when I talk about leverage, it's basically taking loans. They borrow to amplify, the returns that they make on their portfolio. So hedge fund is a big man's world. And you have to demonstrate that you are a serious investor, that you are an accredited investor or a qualified investor in order to participate. So you have to show proof of net worth. You have to show something before they allow you in. And then, in a traditional asset management firm, there are no usual lockup periods. You can accept it, maybe like you're doing a fixed deposit, something. You can easily put your money and withdraw your money at any time at the money market fund.
Absolutely.
But hedge funds have lockup periods. You have to, if it's, for instance, some hedge funds will say you have a lockup period for 1 year, and subsequently you have a quarter lockup. So That's really how it works.
I like the fact that you even stipulated the fact that asset management firms must be investing in something.
Yeah,
they must be upfront with it. Like, are you investing in real estate? Do you guys invest? What exactly do you guys invest in? To get my ROI. So,
so even hedge funds do those things. They tell that to their clients.
Okay.
If I'm coming to a high net worth individual to say, okay, we just launched a fund X, Y, and Z. The high net worth individual wants to know what we're investing in. He wants to know where his money is going to. Do you have the mandates to? You can't tell for instance now, if your fund does not initially state it that you're going to be investing in crypto, you can't now take the money from the client and then go over and buy plenty of crypto. It's not in the mandate. But if you've reached that agreement with your clients and you say, okay, this is what we're investing in, this is what we have in our private placement memorandum. If you state all those things very clearly, you can.
And that would even boost, the confidence. I'm talking about the fear that these people have. That's something that would even help, ease it a bit. So let's segue a bit, like our founder used to say, into something, much more recent, and which is that bit sensitive, the recent crypto crash. For someone who doesn't understand, from your perspective, what went wrong?
Okay.
In simple terms.
Okay, so now I'm going to struggle to put this in basic terms, but the ideal thing is that every market experiences such moments. So for instance, the crypto market, that event actually happened around all-time highs. Now, when the market reaches all-time highs, let's say an all-time high is $120,000 per Bitcoin. When the market reaches an all-time high, investors have to come together and agree. This all-time high, and mind you, when you're in all-time highs, you don't have historical data to back you up. You don't know what happened in the past. You don't know how investors reacted to it in the past, right? The only thing you know is, okay, we're at all-time highs, and the last time we got here, everybody sold off. We couldn't agree. Now, when the markets got to all-time high, and investors couldn't really bring themselves to agree that this should be worth more from this point, we can take it from here, the market simply sold off. So for the price to actually go higher, someone has to be willing to buy at that higher price. And if the market trades into certain territories and nobody is buying, investors are not committing capital, they're not buying at that high, the market automatically goes back to just goes downwards. So, I mean, am I being too technical?
No, not well, still a bit, because I remember when Donald Trump was sworn in, that was when we saw the sporadic spike up to about $100,000, and I think after that it still plateaued a bit. But why is this so devastating in particular? Like this one in particular, I heard some people even lost so much that they even lost their lives. About 4 crypto influencers at the moment. So for people who were affected by this, what would you say your words of? I wouldn't,
to be honest, I wouldn't have any thing to tell anybody who lost money in this, fiasco, other than, you have to watch it. A lot of the people who lost heavy money, it was mostly caused by leverage. Now, if you are trading conservatively, managing risk, and you have that type of crash, you have that type of, situation in the market, ideally, you should not be getting wiped out. You would lose some portion of your portfolio. You might go down 30, 40, 50% on your portfolio, but you're not getting wiped out. That's where risk management comes into it. And where I've seen over time, what I've seen over time is that a lot of traders, a lot of investors, they play the game of certainty in a business that is absolutely uncertain. The only thing that is certain in this world, in the investment landscape, probably it's not, it's 100% to a bit closer to 100% is bonds from the government.
Yeah, mutual funds.
Yes. Every other thing is under probability. Stocks, currencies, whatever. Anything else you trade is under probability. The only place you get certainty is you go with bonds. And of course, we've had instances where nations defaulted on their debt. We had the Greek crisis. We had the ones in Russia. So we have those type of instances. So the problem we have is that traders play that game of certainty. And where for instance, I was having a conversation yesterday with a very young portfolio manager, and he was like, I'm expecting the market to crash more, and if it comes down more, I'm going to load up heavily, I'm going to double the leverage. And, and then it reminded me of what I was in my 20s. I said, well, I miss the aggression that comes with being younger anyway, but that's the type of situation that leads to that type of meltdown. You must be extremely conservative with the risk, and at no point in time should you ever think that you are certain or that you know what is going to happen. None of us knows what's going to happen next. An absolutely good setup, you could buy at a very, very good discount, and the market decides that it wants to keep going down. For instance, in the crash of 1987, the world markets all over, the markets were tanking. The market was crashing heavily. The US market was down. And then we had an instance where the Dow Jones was down, and it took the Dow Jones 2 years to recover from that crash. But when you get to a place like New Zealand, the market in New Zealand did not recover within 2 years. It recovered within 5 years. So let's say you were a trader trading in New Zealand, and then you've seen that the markets in the US have recovered and every other market has recovered, and then you go into buying securities, within New Zealand at that time, banking on the certainty of the fact that it's going to recover, and then you get dragged on for 2-3 more years before it recovers. So you don't have any type of certainty in this business whatsoever. No certainty.
You wouldn't advise that, like that young portfolio manager you were talking to, would you say that's somewhat a bad mindset to have, that the fact that it has crashed down, you just want to get as much as you can? Or what would you advise people who intend to invest?
I mean, if you're going to invest, first of all, the first thing you should do is you should understand what you're investing in.
Okay.
You should understand what you're investing in, and you must always think about risk. There's always risk in the market. You don't know what's going to happen. And for those who are looking at it and saying, oh, the market has dropped and I'm looking to now buy. If you were looking to buy, let's say 100,000 units, you have $100,000 to invest on the portfolio. How about you start with 10% of that and see what happens? Go in conservatively and see what happens.
But they say low risk, low returns.
So now that's the thing. A lot of the main reason why people get into trouble in this line of work is that they're not really looking to play the long game. They're not looking to play it long. They're not looking to do this for the next 30, 40 years if life allows us. And you're simply trying to come up overnight and, buy a Benz and, have a certain kind of lifestyle. That's not, what this is about. This is about compounding your income over time and allowing the law of compounding to do the job. But, a lot of times people just don't, understand the need to be conservative. Myself, when I was much younger, I was quite aggressive with my trading, but eventually the time on the market teaches you that that's not how to do this if you intend to do this.
You did mention, even during episode on the novice, you mentioned that I think you had like 2 devastating losses. That one, you even loaned money from people, and you even still exactly. So I've had those moments, and in coming out of those instances where I had a lot of people's portfolio under my management, and that happened at the time. This was happening about 6 years ago. So the lessons that I came out with from there, it's crazy. I mean, when you look at a company like BlackRock, for instance, Larry Fink himself lost $100 million. And after losing $100 million, he came out with lessons that helped him to build BlackRock to what it is today. So the ideal thing is you can have such moments, like if you've been wiped out by by the recent crash. If you got wiped out, some people lost 10 million, some people lost 30, some people lost, a lot of money on the market. There is always a way to rebuild yourself. But when you're rebuilding yourself, you have to rebuild yourself knowing that the market is the big brother. The market is the boss. We are all playing this game of uncertainty, and we must manage risk, and we must do it with absolute caution. And I think, the Ukrainian guy that unfortunately, unalived himself had a lot of people's, money on the portfolio, and, he just, couldn't stand it. So if you are responsible for people's money, and this is why the SEC is interested in what you're investing in. If you are responsible for people's money, you can't just play that game. It is much rather you have investors leave your firm for, they say, oh, they're not satisfied with the returns. They expect 20%, you're delivering 15%. It is much better, so long it's certain.
Yeah, it's much better to have that type of scenario than to wipe everyone out trying to pursue 80%. So deliver 15%, and whoever's not comfortable with it, they can go find another money manager to do the business for them. But on your own end, you're still good. If they want their money back today, there is there. If they want to, retrieve their money, it's there for them. Not that, everybody gets wiped out and, that type of situation.
And coming full circle, what would be that final advice you have for the young Nigerian who is afraid or scared of investing?
So the young Nigerian who is scared of investing, I'll honestly tell you to not be afraid of investing, because here's the truth. If you don't invest the money, inflation is going to eat it away. There is no way, there is no idle place to keep money. No idle place to keep money. If you keep it in a bank, inflation eats it away. In fact, they might even chip away at some, they take away some charges, some of these things. That is even outside of what inflation is going to do to the money. So the ultimate thing you should do is think about your future and just take the risk in steps that you can afford to lose. If you cannot afford to lose it, don't invest it. Like, just think about it as money that probably you want to dash it out, or you want to, use it to do giveaway, or you want to use it to buy a bottle of Coke for yourself. Think about it in that axis. And when you invest the money, assume it's gone. Don't assume it's there. Don't go thinking about it and, trying to see how you can bring it out back and spend and all of these things. Now, if you invest it, just think about it as something that's already off on the side. And then eventually you figure out a way how to just get through it. So that's it.
Thank you so much, Chikwado. And it's a wrap, guys. As you learn, stay smart, stay safe, and start small. And of course, learn before you start investing. It's been a pleasure.